You pay your credit card on time, every single month. No late payments, no missed bills. You're doing everything the internet told you to do. And yet, you open your credit app and see the number barely move. Maybe it goes up 3 points. Then the next month, it drops 7 for no reason. Meanwhile, someone you know is constantly buying stuff with credit cards, carrying balances, and somehow their score is higher than yours. So you start wondering, what am I doing wrong? But here's the strange part. You might not be doing anything wrong because the credit score system isn't actually designed to reward people who avoid debt. It's designed to reward people who use debt in a very specific way, which means the very habits that feel financially responsible can sometimes keep your score stuck. And once you understand how this system really works, you start realizing something uncomfortable. Your credit score isn't just measuring responsibility, it's measuring how profitable you are to lenders. Visual cue, phone credit score app stuck at the same number. Visual cue, score meter bouncing up and down randomly. And if you don't know the rules of this game, you can follow the advice, pay everything on time, and still stay stuck. Let's talk about the most common frustration people have with credit scores. You finally start getting responsible with money. You stop missing payments, you budget better, you stop maxing out your cards, and you think, okay, my credit score should skyrocket now. But instead, it crawls, like you're running on a treadmill that's set slightly faster than you can run. You're moving, but somehow you're not getting anywhere. Visual cue, treadmill with credit score number floating above it. The reason? Because paying on time is only one piece of the credit score puzzle. In the US, your credit score is influenced by things like payment history, credit utilization, credit age, credit mix, and new credit inquiries. And here's where things get weird. Imagine 2 people. Person A uses 1 credit card responsibly. Person B has 5 credit cards, a car loan, and a personal loan. Guess who the system often rewards more? Person B, not because they're better with money, but because they're more active in the lending system. Visual cue, 2 characters standing next to different credit profiles. This is where people get confused, because the financial advice most of us hear growing up is simple: stay out of debt. But the credit score system, it actually rewards controlled participation in debt, which creates a weird contradiction. The system doesn't necessarily want you to avoid debt entirely. It wants you to borrow predictably. Borrow, pay, borrow again, like a hamster wheel. Visual cue, hamster running on wheel labeled credit cycle. And if you step off that wheel, your score might stop moving. But here's the key thing you need to hear. If your credit score feels confusing, that doesn't mean you're bad with money. It means you're interacting with a system that was designed primarily for lenders, not consumers. Hey, my name's Red, and I'm obsessed with figuring out how money actually works. Not the motivational Instagram quote version. I mean the real system behind the system, the stuff banks understand, but most people were never taught. On this channel, we break down credit scores, debt traps, wealth building, and how everyday people can actually build financial stability without needing a finance degree. Quick disclaimer though, this video is education and entertainment only. I'm not a financial advisor. Always talk to a qualified professional before making major financial decisions. Alright, now let's talk about the hidden shift that keeps a lot of credit scores stuck. Most people experience 2 phases with money. Phase 1 is survival mode. This is where you're just trying to stay afloat. Bills are stressful, savings are small. Maybe you're paying off credit cards. Maybe you're dealing with student loans. Maybe inflation just keeps eating your paycheck. Visual cue, bills piling up on a kitchen table. During this phase, your goal is simple. Don't drown. So you start doing responsible things. You pay on time, you stop overspending, you focus on stability. And eventually, things start getting a little better. You pay down some balances, you stop missing payments, your credit score improves, which brings you to phase 2, stability mode. And this is where the system quietly changes, because once your credit score starts improving, the financial industry suddenly becomes very interested in you. Visual cue, mailbox filling with credit card offers. It feels like progress, like the system is rewarding you. But what's actually happening is something else. The banks now see you as a reliable borrower, And reliable borrowers are profitable because they tend to carry balances sometimes, open new accounts, and increase spending over time. And this creates new traps. Trap number 1, lifestyle inflation. You start making a little more money and suddenly everything upgrades. Better apartment, better car, better subscriptions, better everything. Visual cue, lifestyle upgrades appearing like game power-ups. Trap number 2, credit expansion. More cards, higher limits, more available debt, which can actually make your credit score fluctuate if utilization spikes. Trap number 3, decision fatigue. Now you're managing cards, loans, subscriptions, investments, insurance, rewards programs. Complexity increases, and complexity creates mistakes, which is exactly how the system keeps people participating. Not maliciously, but structurally, because lenders don't make money from people who avoid debt entirely. They make money from people who use debt responsibly, but consistently.
Let's make this simple. Imagine 2 people with credit cards. Person A uses a card for emergencies only. They spend maybe $200 a month. They pay it off, no balance, very low utilization. Sounds responsible, right? But from the credit scoring perspective, their profile looks inactive. Now imagine person B. They spend $2,000 a month on their card. Groceries, gas, subscriptions, travel. They pay it off every month too. But the system sees more activity, higher credit limits, more transaction history. So even though both people pay on time, person B often builds credit faster. Now add time into the equation. According to Federal Reserve data, the average credit score in the US is around 714, but reaching scores above 760 often requires many years of credit history, multiple accounts, and consistent usage patterns. So if your score feels stuck, sometimes the missing ingredient isn't behavior. It's simply time and activity. And that leads us to a story that explains this perfectly. Let's meet Alex and Jordan. Both are 27. Both recently decided to get serious about money. Both have credit scores around 650, and both start doing the responsible thing. They pay their bills on time, they stop missing payments, they pay down their credit cards. After about a year, both of their scores rise to around 690. So far, identical. But then their paths start diverging. Visual cue, split screen labeled Alex versus Jordan. Alex decides they're tired of credit cards. They close 2 accounts, they keep only 1 card. They barely use it, maybe $100 here and there. From Alex's perspective, this feels safer, less temptation, less debt. But the credit system sees something different. Shorter credit history, less activity, lower available credit. And Alex's score stalls. Meanwhile, Jordan takes a different approach. Jordan keeps old accounts open, uses 1 main card for everyday spending, groceries, gas, phone bill, streaming, then pays it off every month too. Jordan's credit utilization stays low, but the account stays active. After a couple years, Jordan's credit age grows, credit limits increase, credit mix improves, and the score climbs past 750. Here's the important part though. Jordan didn't go deeper into debt. They simply played the system differently. Same discipline, different strategy. So if you want to improve your credit score without falling into the debt trap, here's a simple framework. Rule 1, never miss payments. This is the biggest factor. 1 missed payment can damage your score for years. Automate everything if possible. Rule 2, keep credit utilization low. Try to keep credit card balances below 30% of your limit. Even better, below 10%. Example, if your limit is $5,000, try to keep balances under $500. Rule 3, don't close old accounts. Credit age matters. Closing your oldest card can shorten your credit history, which can lower your score, even if you rarely use it. Rule 4, use cards, but treat them like debit. Use them for normal spending, groceries, gas, bills, then pay them off monthly. Activity helps your profile. Debt doesn't have to. Rule 5, ignore fancy credit card marketing. Travel points, rewards, exclusive cards, most of these exist to encourage more spending. If rewards cause you to spend more, they're not rewards, they're bait. At the end of the day, your credit score is just a tool. It's not your wealth. It's not your success. It's simply a measurement used by lenders. But when you understand the rules, you can use that tool to your advantage. Lower interest rates, better loan approvals, more financial flexibility. The real goal isn't chasing a perfect number. It's building a life where money stops controlling your decisions, where emergencies don't destroy your stability, where you have options. Because in the end, financial freedom isn't about impressing a credit bureau, it's about owning your time, your choices, your future. And the real catch is this: your credit score isn't the destination, it's just one of the doors that can help you get there.